This conference will now be recorded.
I see Frank.
This conference will now be recorded.
For those of you who are new, my name is Todd Smith. I'm the owner of Level 5 Financial. We have a few of our staff on. So today is what? April the 4th, or no, the 6th, rather. And like I said, this is our monthly coffee chat that we've been doing now for 3 months. And just want to let everybody know that this is really a Q&A. It's time for people just to hop in, ask any questions they may have. You can also be a fly in the wall. If you don't have any questions, you may learn from other questions being asked. So unlike our educational seminars or webinars that we have typically every month or every couple months, this is really designed just to be an open forum. And so I don't typically have anything prepared, though I do have questions usually that people email me. So that's kind of the format. We have Frank Zawatsky on the line, Tracy's on the line. Hey, Laird, how are you? Good to see you. No Ginny today?
No, she had to go into town this morning.
Okay. All right. How are you doing?
I'm doing well.
Yeah.
Yep.
You're up the hill as well. I believe Robert's on the line. You guys are both up the hill, so it's decent spring weather almost. Is it turning into a mud fest, or what is it like?
Yes, absolutely a mud fest. Absolutely.
Yeah. Well, we have, what is it, till Mother's Day typically before we're out of the woods, but we'll see. This year we might be all right.
Yeah.
You can use the moisture, right?
Right. Always.
Didn't you used to do something with search and rescue?
Oh, yeah. Yeah, I was with Teller County Search and Rescue for 8 years.
Yeah.
So, yeah.
You don't do any of that anymore.
No, I can't keep up with the young guys.
Yeah.
I mean, we used to go up and down Pikes Peak once a month, I mean, January, July, whatever.
Yeah.
And it's pretty hard with a 40-pound pack.
Yeah, that'll keep you in shape though, for sure.
Yeah. I was afraid I was going to have to be rescued, so I decided to not.
That kind of defeats the purpose, doesn't it? If the rescue has to save the rescuer.
Yeah.
Yeah. Okay. Well, good to see you again.
Yeah.
I'm also, if you're familiar, today's a little light compared to what we've had the previous months. But if you recall, we've been doing coffee chat as well as a happy hour on the following Thursday to try to give people opportunity to attend at different times and different days. Considering consolidating the two just for the time being, this isn't something that I want to force. If there aren't a lot of questions, maybe that's a good thing. But if the volume increases, maybe we'll break them out again. So just an FYI. Mechanics of those of you who know, first quarter 2021 was really an estate planning theme. So we sent out beneficiary and estate planning documents to all clients to make sure your beneficiary designations were updated, that your estate plan is intact, and we offer to review all documents for people as well. So if you haven't done that, I don't think you have, Laird, not to put you on the spot, but anything you can get back, we're kind of closing the door on Q1 now that we're in the second quarter for estate planning type stuff. Then moving into our theme for Q2, which is really tax planning. Not to give you more work, but we're asking everybody to upload your completed tax returns, and then we will review it to make sure A, there aren't any mistakes, and B, are there any planning opportunities that are kind of told by the tax narrative. There's a lot that we can glean from the tax return. So if you upload those to your personal financial website, we'll review those, and then you also have a digital copy as well. So that's kind of what's going on here. We'll probably, our educational component this quarter will also be tax related. So we'll probably have a tax webinar either at the end of this month or actually we may push it off to June, we'll see. But look out for that. So does anybody have any questions or pressing stuff that they want to talk about today? Larry, do you have anything, or are you just here to visit?
Well, I guess mostly just to visit, just to kind of see what's going on. And I guess the only thought that I really have kind of come up with, I know Jen and I've kind of procrastinated on the, on the all the stuff that we need to do for, what is it, the estate planning. And I guess I've kind of felt that the estate planning and the tax stuff all kind of goes hand in hand. And hopefully we can try to get all of that stuff done here in the next couple of weeks. I know that our taxes have kind of been done. We've sort of signed off on them, and we'll get that to you. That's pretty easy, but the rest of it, I'm really not sure. And it just seems like there's so much to do with all of that beneficiary and stuff. And I don't know, we might need to just sit down with you sometime in the near future and kind of go through some of that other stuff. And I can't remember what everything that you said, and I don't have all that paperwork in front of me, but we'll go from there sometime. So anyway.
Well, that's good feedback, Laird. And, I sometimes think that, I'm always trying to create more value and more stuff for people, and how can we better serve? So sometimes we're sending a whole bunch of stuff out at once. So if it's too much, that's good to know. And what I would recommend is it's really one step at a time. So step one really in that whole kind of packet that we sent you was just make sure your beneficiary designations are correct on the accounts. So if those are correct, you don't need to send anything back to us. If you need to update anything, there's just a form that comes back, and I or Tracy can help you with that, or even Frank. Okay. After that, it's really, do you want to designate it a trusted contact? So this year, we're really trying to push that everybody have a trusted contact on their accounts. So that's years ago when we opened your accounts, for instance, we never really put a trusted contact on there. That's not a big deal really either, Laird. That's really another form saying, here's the person I want you to call if we can't be reached, or there's an emergency, or we even think there's a situation of elder abuse. So that's all a trusted contact is. So it's similar to a beneficiary, except the beneficiary receives the assets upon your passing. The trusted contact is really for your protection more than anything else. So those are the two kind of account maintenance things that are pretty straightforward. The third is maybe a bigger topic. It's all the estate planning documents. And we're offering to help people facilitate that either internally using a digital platform that we partnered with, or getting you to go to an attorney if you need to have things updated or created. So those are the three main areas, Larry, but I would just say one step at a time. When we meet next, I'm happy to go through that with you as well. So we can meet sooner, but we're looking at doing most of our mid-year reviews and meetings in May. But we can meet sooner if that helps. Does that clarify a little bit, or does that make it more jumbled for you?
No, I think it helps, because there's the differences that we I guess didn't really quite understand was, just the thing of the beneficiary, and then the trust in itself, and how that actually gets set up. And I guess that's the only thing that we've kind of really discussed, and we don't know who we would really put in there yet. I mean, things have changed. with Jin's mom passing and, just family things, issues, have all changed. So, and I guess we probably need to go back and sit down with our lawyer and kind of review, our will and all of the other stuff that we have. So I guess that's kind of, one of the things that's kind of slowed us down because we don't know which way to go just yet. So.
Well, so we're think of this as us just opening a conversation, and we are just trying to be the motivator of getting these things done. So we don't expect you to understand or know all the nuances. So that's why we want to, you'd raise your hand and say, Todd, yeah, let's dedicate some time to talk about this particular topic. At this stage, you probably don't need a trust. And if you remember, I think you were at the estate planning webinar that Frank really ran. You have your will, you have your will substitutes. So your will substitutes will be your beneficiary designations, things like that, and or a trust. So if most of your assets are in accounts and bank accounts, investments accounts, et cetera, and you have proper beneficiaries, then most everything is taken care of. Anything that's outside of that will go through by virtue of your will. So if those are all updated and seeing your attorney and your will is updated and it's at least been the last couple of years, you're probably fine for the most part. You don't really need to add a will or a trust unless there's a little bit more complexity and sophistication that you may need in terms of the disposition of your property. So what I know about you and Jen, you likely don't need a trust at all. So I'd remove that from the equation, and really focus on having your will that's updated, having the right powers of attorney, right? So you want to make sure that your healthcare proxies and your financial power of attorneys are up to date and correct. And then your beneficiary designation, So most people, what we find is that the majority of their assets are either in investment and retirement accounts or their bank accounts and their house. And anything outside of that is really going to, is personal effects. So if you have things titled properly in those three areas, those main areas, then you should be fine. It doesn't need to be this huge project and as complex as you may think it is. So I don't know if that helps at all. Is your attorney up there? Is it Meg or Ethan or?
No, it's the attorney's actually in the Springs.
Okay. So I would say, scheduling a meeting with him or her would be a great first step, but we're happy to step in between to help you corral this stuff so that you know what you're doing.
Okay, sounds good.
Our goal is not to create complexity. Our goal is to try to simplify things. So sorry.
Well, for the average person, it's probably, simplified. But, for us, I guess we really don't think in that stuff. I don't know. We're just both scientists and that's what we think about, not financial stuff and everything else. I don't know.
No, I understand. Yeah, all our brains work differently. The only thing I could say is just documentation. So if you're a scientist, you're documenting, whatever, it's similar. And trust, for instance, has this kind of, I don't know, people think of trust, but all that is a contract. A will is just a contract. A beneficiary designation is kind of a contract. So all it is saying, this is what I want to happen, and you're documenting it, so.
Right. Okay.
So yeah, let's talk more about that if you want. We get something on the calendar, just talk to Tracy or whatever, and we can at least have a phone call or in-person meeting, whatever you want to do. So.
Okay. All right. Sounds good. Thanks.
The tax side, once that's completed, we want your tax return as well, just as a reminder. So we'll look that over and kind of give you a summary of what we've spot there. So again, that's to synthesize. Most people's tax return are this thick and they don't really understand it. So again, that's just our effort trying to synthesize information and make it easier for you. Not that the CPA is necessarily not doing their job, it's just a second step of oversight. And then from a planning standpoint, financial planners tend to look at things at a different lens than the CPA. So it's that kind of marriage of the two different viewpoints that gives greater impact that we find for people. So, so anyway.
Okay, sounds good.
Any other thoughts or discussion points from anybody? Okay. Well, I do have a few discussion points that came up with people lately that maybe I'll address, and then we will call it a day. So actually, Frank, since we're talking about this, we're moving into, and I think yeah, there you are. If whoever doesn't know Frank Zawatsky, even though he's showing as me, he's another CFP on my staff here. So he gave the estate planning presentation, but he does a lot of the financial planning kind of behind the scenes, as well as the tax review that we're moving into this year. So I thought it might be helpful just to talk briefly, what are some of the common things that we're looking for when we're evaluating a tax return, Frank? And maybe some of the common strategies. I wouldn't go too deep in the weeds, but maybe just address that real quick.
Okay, hopefully everybody can hear. A couple things I usually look for is trying to determine what marginal tax bracket people are in, because that drives the tax cost of anytime you have a possibility of getting some additional ordinary income. Knowing how much that's going to cost you in additional taxes is a worthwhile thing. I always look for in Colorado, anybody who's over 60 and retired, I want to make sure they're getting their senior exemptions. We've found some cases where, the CPA has just basically
Tell Frank he's muted. You're muted, Frank. There you go. Sorry.
it says unmuted.
Yeah, now you are. Yeah, I don't know what happened. Yep.
Oh, what I was going to say is for Colorado residents, I always look to see if I don't know where that's coming from.
That's my phone. Go ahead.
I try to look and make sure people are getting all the senior exemptions that they're entitled to. I also look to see where they fall in the capital gains taxation. People don't realize capital gains can be taxed at 3 different levels. And if someone has an income that's low enough, it's possible for us to take capital gains through some sale of a security, and basically the person gets a profit and an increase in the cost basis of the investment when we buy it back at 0 tax costs. So there's some opportunity, and if you don't know that you're going to be in that area, you don't know to do it. So it's that we look for tax losses, just different things. We have some clients that are self-employed, try to make sure if they're entitled to it, they can take their healthcare costs off on Schedule 1, because self-employed people can deduct their healthcare costs, things like that. Again, the CPA may not be aware of, or the individual, the client, may not have told the CPA in many cases because they weren't aware that there's a possible tax break there. So just looking for oversights and opportunities.
Yeah, that's a good point. Yeah. I was going to say what our goal is to hopefully give everybody at least a 1-page synopsis of what we found, if anything, or at least observations, so they can then take it to the CPA. So that's kind of my marching orders for future tax planning reviews that I plan to do at least once a year. So if you remember these themes that we have each quarter, I think tax planning is more and more prevalent as we see. You've heard about, Biden coming into office and tax rates going up. And I think as we see how kind of the dust settles from a new administration, I think there's going to be more and more planning opportunities. So for us to be involved, I think is becoming more and more important. But then also anything that we do on behalf of clients really touches tax and vice versa. So we need to be aware of all those things. So what would you say, Frank, for somebody that, for retirees out there, are some poignant things to look for, or we're seeing that maybe you'd bring up?
Well, like I said, for Colorado, the senior tax exemption, it reduces the amount of your income that's subject to Colorado taxation. You always want to make sure you don't miss on that, and you want to use it completely. Look for possibility to maybe harvest some capital gains at no tax cost, which saves you in the long run. Possibly Roth conversions. Some people who are they haven't had, they're young enough that they're not required to take minimum distributions to their IRAs yet, and they're living on Social Security and maybe a pension or whatnot. Sometimes there's an opportunity to convert an IRA to a Roth IRA at a pretty low tax cost, as you call it, Todd, bumping the bracket. There's just strategies that once they're gone, they're gone. So you have to take advantage of them each year as they come along. And so those are some of the things I try to look for.
So simplify this for me, if you would. Simplify what tax loss harvesting is, and of course, tax gain harvesting. Just walk us through what that actually means.
Okay, well, the way your tax return is completed when it comes to capital gains is they take realized, in other words, from transactions that have already taken place, you sold something. You take the gains and you take any realized losses, and they offset each other. And then if there's a net loss, you're allowed to reduce your income taxes for that year, your taxable income, by $3,000. So we're watching. Nobody wants to. Nobody plans to create losses, but unfortunately, they do happen from time to time. So we try to take advantage of those to save you taxes in that current year. And like I said, we try to not carry too many losses forward if there's an accumulated loss. We try to use those up as fast as possible. So it helps us guide us in managing maybe some investment changes and rebalancing and whatnot. For gain harvesting, there's very few people seem to know this, but if your taxable income for a joint filer, a married filing jointly, is under $80,000, the capital gains are tax-free from a federal standpoint, and $40,000 for an individual. So those are sometimes things we can manage to cause your profits to not be taxed, and it's a real nice way to gain a tax advantage. And once the year is up, that opportunity is lost. So we try to not let those pass without at least being aware and exercising them when we can.
Yeah, and I think when we look at April this time last year, essentially when we had the big dip in the markets, that's something we're doing behind the scenes, is looking at, when we have a drop in the markets and account values, do we go in and harvest losses? Because then we can buy right back in and kind of get intrinsic value from realizing that loss. But the point I guess I wanted to make was, without your tax return, we're kind of operating in the dark, right? So we need to know what your other taxable income is, what bracket you might be in, to know that if these strategies are even viable. But at the end of the day, we're going to your CPA and accountant anyway. We're saying, hey, here's a strategy we're thinking. We understand it, that you're in, XYZ bracket. Before we actually do this, we want to make sure that you're not seeing something on the tax return that we need to be aware of. So there's a lot of kind of behind the scenes stuff you may not be aware of.
I was going to say, Todd, another opportunity I came across last fall for some clients, because we had their tax returns from the previous year, had an idea about how much Social Security benefit they were going to get, and were able to harvest some losses in December, which drove their income down, that reduced the taxation on their Social Security. And without knowing where you're at, or where it's going to roughly be from year to year, you don't know if you should do it or not.
Right. So I just want to give an example of kind of what we look at each year, and as planning opportunities come up, there may be more as legislation changes, but in light of us meeting at least twice a year and kind of these meetings and our educational stuff, that's an example of kind of behind the scenes stuff that we're doing on your behalf as well, and why we want the tax return. So let me see some questions or discussion points that came up this week. Did anybody have questions about the tax side at all? Laird or Robert or anybody? No? Okay. So Frank and I talked about this. I had a client mention something to me earlier, I guess it was last week, earlier this week, and had a question about annuities. And one of the comments that she made, well, she said, well, why would I want an annuity? Aren't all annuities bad? And she said, you know, I heard years ago, the only people that make money with annuities are those who sell them. So my response to her, I thought maybe it was a good discussion point here. First of all, what are annuities? Are they all bad? And you know, kind of why we might consider using them as kind of a tool in the tool chest. So my immediate response to her was something to the effect that, you know, saying that all annuities are bad are similar to saying that all pit bulls are bad dogs. And, you know, our goal as advocates for our clients and their families and their colleagues really is to have a multitude of different tools in our tool chest of which we could use given the circumstances and the situation. So for years, many of you know this, I was kind of on the fee only, product agnostic kind of side of the field. And many times I said the same thing, that, you know, the statement that she heard, that annuities generally aren't great vehicles. They're high expense. They're sold improperly by a lot of insurance agents out there. And it's usually because of the commission they're receiving. So for the most part, I would agree with her. But when we look in the context of kind of retirement planning and investment risk, I do think that there is certainly a place for them. And maybe Frank, you and I can kind of talk about this a little bit. First of all, there's different types of annuities. There's fixed annuities and then there's variable annuities. All annuities tend to have some tax benefits, so that ties into what we were talking about. You can get tax deferral in certain annuity products, so that could be a benefit of having that type of bucket. But generally, a fixed annuity is a guaranteed contract with an insurance company. With a variable type annuity, there's still a contract with the insurance company, but it's subject to the fluctuation of the overall market depending on how you invest in the sub-accounts. So I don't want to get too detailed, and probably in the one future quarter we'll get more into risk management, insurance, and some of these things, a deeper dive. But I think I want to just explain to people that not all annuities are bad. You can Google annuities right now and you'll see a plethora of bad media. What we look at is somebody moving into retirement or somebody in retirement. We're looking at mitigating risks, right? So there's a host of risks that we're trying to mitigate. One of them is longevity. Everybody here knows about longevity risk. If you live long enough, inflationary pressure is going to erode your purchasing power. So that's one of the big retirement risks. We look at healthcare and medical risks. That's certainly one. Then we look at investment risks, right? So when you're mitigating investment risk, and I would add tax risk. Tax risk can also erode your returns and also ultimately your income over time. But the investment risk, which has been prevalent with all the volatility in the last year or so, and what we expect going forward, I think is one that is commonly asked about. So when you're looking at mitigating investment risk, you can really be an investor or a non-investor. And sometimes an annuity plays kind of the middle of the road. An annuity allows you to take some risk off the table, but still get decent returns more than sitting in cash and CDs. So what we found is that from a big picture standpoint, if you take a retirement portfolio based on, globally diversified portfolio, based on asset allocation with stocks, bonds, and cash, if you look at that in a retirement kind of projection versus something that has that and a fixed contract like an annuity, it actually enhances the longevity. It can enhance the longevity of the portfolio long term. And part of that is because it smooths out the risk and it removes the sequence, what we call sequence of return risks associated with the portfolio. So if you really get into, if you look at the industry as well as academic research, adding that extra component, or we like to call them buckets, can actually increase the probability of success. And I think what becomes more compelling is that a lot of retirees are more in the bond side, heavier exposed to bonds. And if you look at where interest rates have been and bond yields are dismally low, this then becomes another potential area where you could increase yield, long-term return, and kind of income projection. So I just wanted to open that up. I don't think I articulated that particularly well. So Frank, if you want to speak to that at all, I'd welcome it. But I just like to throw that out there. I get asked this question quite frequently, and I thought at least I would open it up today, and it's on the recording for people that we send this out to. So.
Yeah, I think a good way of putting it is, when you annuitize a lump sum of money, either from within a previously deferred annuity or purchase it outright, you're basically, with the insurance company, you're saying, look, I will give you this lump sum of money and you agree to pay me a certain amount every month for the rest of my life, or the life of a person and their spouse. So when Todd says it takes some risk off the table, that money's no longer exposed to the market. It's just a regular fixed payment that's going to be coming every month as long as the parties to the annuitization are alive. And kind of dovetailing what we talked a little bit earlier about is, I came across an opportunity with taxation where it was a husband and wife, and I mentioned the Colorado tax exemption. Colorado retirees over the age of 65 can get $24,000 subtracted from their Colorado taxable income. And in this case, this household, the husband had a big enough Social Security benefit. He was using his entire benefit, but his wife did not. And for her, it's like you're leaving some unclaimed exemption on the table because you don't have a large enough Social Security benefit. So you might want to consider an annuity. You'll still pay federal taxes, but it'll be lower risk because it's a regular payment, not subject to the whims of the market. And from a Colorado standpoint, it's tax-free. So those are kind of things we stumble across by taking a holistic approach and being aware of the different financial elements in people's mix.
Yeah, that's a good point. And I would just add that, you don't necessarily have to annuitize either. So you can defer an annuity and take income at a later date. So you could take it from an income standpoint. You could carve out a specific dollar amount that puts it in this tax deferred bucket. And then you turn on the income kind of stream at a future date. So you're creating this private pension, if you will, at some future date. So there's really no tax on that money until you actually turn it on. So you don't have to do an immediate annuity, which would create that income stream. You could kind of dovetail it. So I think that brings up something else that we talk about with people is and I mentioned this before, is the bucket approach. And what we try to do with folks, or I try to do with folks, is really say, okay, let's break up what you have into different buckets that maybe have different objectives as well as different tax treatment, right? So people that are retired generally have less flexibility to do that because it is what it is, right? But people pre-retirement generally have a little bit more flexibility where you can create different buckets so that you can tap into them in different manners, and then they're going to be taxed differently. So I had a client, one of the questions I was going to bring up today was about taking loans from your assets or using your assets for loans. This particular person only has the majority of their assets in a retirement account. Why on the front end, that seems really good because they got to take a deduction their whole working career. It's been growing tax deferred, so they haven't paid any income taxes or capital gains along the way. So that's great. It helped accumulate a sizable amount. But now in terms of taking distributions and accessing that money, there's some challenges. So everything, first of all, is going to be taxable as ordinary income, which then affects your what's called provisional income and your Social Security taxation. But then also it's hard to access it without doing that. So there's a little bit less liquidity in that type of account. So what we try to do is structure it so that you at least have 2 or 3 different buckets. So we always want to have the emergency reserve bucket. That's stuff that's always safe, always in the bank. You can get your money today if you want to. Bucket number 2 is probably still pretty liquid, pretty accessible, but we might be investing it a little bit more because, as you know, bank rates are so low. So bucket number 2 might be some bonds or something a little bit higher yield, still safe, could have some fluctuation, but very minimal. And then bucket number 3 would be more your long-term kind of higher risk type stuff, where you could take, maybe more equity exposure, things like that. It just gives a lot more flexibility in terms of when you want to turn on the spigot of income and where you're getting that from. And an annuity can actually be one of those buckets, right? So you're taking risk off of the table from an investment standpoint, but that could be your bucket 2 or your bucket 3. And like I mentioned before, it's been kind of a challenge with, with interest rates where they've been for so long, without any prospect of a huge increase. Yields are so low in the bank. It's where do you go that's in between kind of being in the bank, cash under the mattress, or the stock market. And these other buckets, I think, are viable options. So Laird, for instance, we've done that with you a little bit, but there's a few different conversations here that need to be unpacked. But I think there's tax deferral in annuities. I think there's some risk management in annuities. And then there's something to be said to have a, like Frank was saying, a kind of a guaranteed income stream for life. And if you think about retirement in the context of what are we trying to accomplish, we want to have income for life that, we never outgrow or outlive. So I don't think it's optimal from an investment standpoint, but I think it has its place. So that was very long-winded. Frank, do you have any other additions to that?
Well, I was going to say, as you mentioned 3 buckets, we've had some clients where we've even recommended a 4th bucket, which would be a reverse mortgage, that that gives you several potential spigots of money that you can turn on and off. And if the stock market's down, it's like, well, okay, I can rely on my annuity. I could possibly tap into my HECM home equity conversion mortgage line of credit to pull some money from that. It's tax free. So what Todd mentioned, sequence of return risk. What that really means is the risk that you're forced to sell something in the stock market when it's down, and when you have multiple alternatives to the stock market to fund your spending, it reduces that sequence of return risk because you have choices.
Right. Yeah, that's a great point. Yeah, I think the HECMs, or the home equity conversion mortgages, have gotten a bad rap over the years. I think they've improved, they've been regulated. I think it's another leg of the proverbial stool to turn possible income on if you wanted to. A lot of people have a large percentage of their net worth in their home. It's not, the myths around it have been debunked, and we're happy to do that. But again, it's when I talk about mitigating risks, that's just another asset class that you could add. So you have multiple streams coming from potentially 3, 4 plus areas. And then that other risk that I talked about mitigating is that healthcare. So if you have that traumatic event where you need to be in a facility, you or somebody else needs to be in a facility, how are you going to pay for it? You can certainly pay down your assets, your liquid assets, so that you qualify for Medicaid. Most people don't want to do that, but it gets, as you know, long-term care, if you're in a facility, can be anywhere, $8,000, $9,000, $10,000, depending on how advanced your situation is. So the home equity line, instead of tapping into your other assets, is just another source of mitigating that risk as well. So you start cobbling these things together, I think you get the idea. We're able to mitigate risk a little bit more than than one by itself. So, okay, I think we beat that dead horse there. What else do we have? Oh, okay, so I alluded to the question I got just yesterday, which ties into these bucket approach. So can you borrow from your assets? So from your investment accounts, can you take a loan? So to answer this question, the answer is yes, but it's not something that we would necessarily recommend. And again, it depends on what type of bucket it is and what type of account it is. But generally, you have two broad camps. You have retirement type of accounts and non-retirement accounts. Generally, the IRS does not allow you to use retirement-related accounts to collateralize or as collateral for a loan. Where non-retirement accounts, you can collateralize that. You can use that as collateral for a loan. The caveat is that with a 401k plan, typically, if you're an active employee and you have an existing 401k plan, a lot of those do have loan provisions. You're not using the assets as collateral so much, but you actually take a distribution and then you pay yourself back through your paycheck at work. But beyond that, generally in the retirement space, the IRS frowns upon that. It could be a prohibited transaction. It could discontinue or disqualify IRAs and such from their tax advantage strategy. So the short answer is if you needed a loan or accessibility to some of your funds, and it's mostly in retirement accounts, using that as a loan probably is going to be unlikely. What you can do is qualify for a third-party loan saying I have these assets that could produce XYZ in income. So it's just an income verification like anything else. Do I have enough income and assets to support the loan? So that's generally the answer. On your non-retirement accounts, and I'm not a lender, so let me just throw the caveat out there. This is not my expertise, but this is what I know. So if anybody knows differently, let me know. But on the non-retirement account, say you wanted accessibility and you needed the funds for something, you have a few different options there. You can certainly cash them out and use the funds as you see fit, which is different than a retirement account, which maybe you can't. If you do it if you cash it out from a retirement account, that's all going to be taxable income. If you do it from a non-retirement account, it might be a little bit more tax efficient. It might be taxed at capital gains. You just have to be careful in doing so. The other options really, if you didn't want to actually take the money, is use that as collateral for a loan. And there's lots of lenders that will do so. They will give you a certain amount of money up to a percentage of the assets you have. So it depends on what type of assets you have. Some of them will give you 50% of the value. Some of them will give you 70, 80% of the value. And that could be structured as a traditional loan or a rolling line of credit. And it's usually the LIBOR rate plus 1 or 2% depending on the lender. So that's an option. The other option, which I would definitely not recommend, is a margin type account. A margin account is basically gives you leverage from the value of your account to buy more securities. So it's almost doubling down at the casino. So I would avoid that. But either way, you could be called on the value of your account. So say they lend hypothetically 70% of the value of your account, and for whatever reason, how you have it invested, the value drops, you may have to add money back in to bring that loan to value rate back to where it was supposed to be. So it's an area that I wouldn't recommend, but it's another reason why we want to have buckets. This particular person had all his money in a retirement account. So when we talk about structuring things, that was another reason maybe when he was younger, structuring things in several buckets would have made more sense. So any comments on that, Frank?
Well, I was going to say you might also consider if they had a permanent life insurance policy, like a whole life policy that has cash value, you can borrow from the insurance company and at a relatively low rate because they have your cash value as collateral. That has some pros and cons, but that's still another avenue.
Yeah, that's a great point. I didn't even think about it. That's me being somewhat anti-insurance. But an IUL, what's an index universal life, I think is kind of similar to the annuity discussion. It's another way to take risk off the table. It does, it almost gives a Roth-like bucket in terms of, tax advantages, and it does allow for loans like that. You can tap into it. But yeah, good point. Good point. I guess the moral of the story is 20 plus years that I've been doing this, I don't think I've ever had anybody take a collateralized loan on their securities, and I probably wouldn't recommend it, but it's possible, as long as you know the pitfalls. What else do I have here? So we talked about common tax strategies, Roth, gain loss harvesting. I guess there was 2 other questions. This always leads to bigger conversations, but I had somebody ask me about, and I know my answer, and I bet what you'll say, I know your answer too, Frank, but they wanted to invest in this particular VEGN. So they wanted to go buy with their portfolio the ticker VEGN, which is the US Vegan Climate ETF, and asked my opinion on that. So for those of you that are meat eaters or vegans, maybe you know this. So this falls in the realm of what started back, gosh, what was it, the 70s or 80s, Frank? The SRI, or the Socially Responsible Investing Calvert Fund, I think was the first fund out there. Since then, it's evolved and kind of turned into a much bigger segment of the investment world. But for those that had some kind of, were more interested in investing their dollars that mirrored their values, there's the socially responsible investing, or now what's called ESG, which are kind of similar but a little bit different. ESG stands for environmental, social, and governance. So what this really means is that you could take a portfolio or the way you invest and use algorithms and screening techniques to then weed out particular investments that don't meet your values. So if you are really concerned about, say, big oil or pharmaceuticals or climate control or climate issues, there's ways to screen your portfolio for that. And so that's what this person was asking. They chose, actually, it started the conversation saying, should I invest in this company that's, maybe you've heard Beyond Meat. They want to buy the stock in this company that produces Beyond Meat, and that's like hamburger or steak alternatives. There's actually a place right down the street here, Santana's Grill, that serves burgers that uses Beyond Meat. It actually tastes pretty similar to a burger, so it's not bad. So she had asked, what is your opinion of me going and buying stock? So there's a couple different conversations inside of this question. First, we don't recommend, for the overwhelming majority of our clients, or anybody for that matter, to invest in individual securities. And there's several reasons for that. Individual securities are risky, they're expensive to get. And if you're talking about stocks as individual issues, you're really going against, the biggest analyst firms out there. You're going against supercomputers. So for you sitting in Colorado or anywhere thinking that you're going to be able to stock pick, I think is just a risky game. So we generally don't recommend individual securities. Frank wrote a good blog, gosh, it's been a couple months now, that I recommend you go read about the success of individual stock picking. And I think it was something, correct me if I'm wrong, wasn't it like over several decades, the returns of the stock market were only came down to like 30 different stocks or something like that, Frank?
Well, it goes all the way back into the 1920s.
Is it that far? Yeah, I couldn't remember.
Yeah, and it basically, out of thousands and thousands of individual stocks you can invest in during that time, nearly all of the gains came from a handful of them, and there's no way to know in advance which ones they are. And I think that kind of highlights Todd's risk, is it's really trying to find a needle in a haystack, and you're probably not going to be able to. And also, like we said, it's pretty, I used to invest in individual stocks, and one day the light went on for me. It was, how do you think you're going to be able to pick them better than, like Todd said, people who have supercomputers and tons of information and access to corporate management? They're probably going to do better than you are, Frank. And that's when I stopped doing it.
Yeah, I think there's, I mean, you know, I never want to rain on people's parade, and I'll support them in any way I can. We're always looking at things about risk mitigation. I keep talking about that. So when we're managing people's money or we're educating them to invest on their own, it's really understand the risk versus return attributes, and most people don't. And when you get in the individual securities game, there's a lot more risk than one may think. So we're always going to be looking at more mutual funds and exchange traded funds. And I always use the example. I said, you can go out and buy Beyond Meat stock, or you can go buy XYZ mutual fund that owns 200 or 300 different stocks in that basket. For $1,000, you could buy each. Which one do you think is better? And the answer isn't always better in terms of potential rate of return, but it's that getting decent returns, but while spreading out your risk in a well-diversified basket. So that one stock, I always talk about the book Too Big to Fail. I think it's a movie. Any one stock could go away at any time. You know, so when we're managing people's money, and generally it's people in their 50s, 60s, and 70s, this is their nest egg. We're not going to be taking chances on individual securities or even what we prognosticate to be the next best place to be. You know, every year we get the same question: should I be in gold? Should I be in real estate? Should I be in technology? Should I be looking at bio? Should I be looking at alternative energy? Frank and I were both in the business back in the late 90s. I can't tell you how many people were asking me to buy a tech fund, and I said, no, it's the same thing. You know, we're happy to give up the high flyers and those home runs for the proverbial, you know, singles, doubles, and maybe a triple here and there, right? So if we can get decent returns to make people's financial plan work while mitigating the risk, especially if they're spending, that's what we're trying to achieve. So back to this conversation, that was kind of layer number one. I wouldn't buy an individual stock. Number two, if you want to buy something like that that's of interest to you, I think that's fine. You want to probably limit it to a certain percentage of your portfolio. So I'll support somebody and say, you know, if you want to dabble in individual stocks or particular areas of interest, limit it to 5 or 10%. That's your fund money, and we'll help you kind of with the more serious money that your retirement kind of depends on. But back to SRI and SSG, what we found over the years is that to invest in that way generally hurts your returns. And there was a big gap between your rates of return or potential that you could do elsewhere versus, you know, in the socially responsive space. Over the years, most recently, what I've seen, the data has kind of changed. The data has kind of indicated that companies that generally strive to be good companies and have good corporate governance, are socially responsible, care about the climate, actually tend to perform a little bit better. So that divergence of performance and values has kind of changed, and now we're seeing more and more solutions that make a little bit more economic sense. But regardless, some people just want to invest with their values, and so we do have some portfolios that do have a screening across all asset classes if somebody's interested in that. This particular ETF that she was asking about was only in one particular sector. If you look it up, it was VEGN. That was all US large companies with a socially responsible screening on it. So I came back to her and said, that's fine. We can certainly do that. I would recommend, instead of just doing one, if this is really important to you, we'll structure a whole portfolio that's globally diversified across all asset classes in the same vein. The other thing to be aware of is generally when you add those type of screenings, your investment expense is gonna go up. So for those of you who know, our portfolios generally, I haven't looked recently, but are what, 8 basis points, somewhere around there, less than 10 basis points, which is 0.10 of 1% is the internal cost. So very, very low cost. And that's important because it's not eroding your return, right? So we're very conscious of that. But once you get into SRI and some screening and a little bit more complexity that requires more research, more human components to it, the expense ratio is going to go up. So by comparison, that particular ETF that she was looking at, the VEGN, has an expense ratio of 0.6. So you're looking at almost, it may not sound like a lot to you, but you're looking at, 6 times the expense. And unfortunately, in the investment world, it's not always what you don't get what you pay for. And generally, a higher expense ratios means worse performance. So it's something to be aware of. But most people don't know if there's something that's true to your heart, and as you get older, these things maybe are a little bit more prevalent. There's a capability that we have. Thoughts on that, Frank?
I was going to add that, and that additional 6 times as much expense, you pay it year after year after year after year. It's not a one-time event.
Right. So it's like anything else. It's pros and cons, and that's our job is to say at the end of the day, it's your money, right? You can invest how you want. What our job is to give you the pros and cons, say here's the risk, here's the return, give you enough data to make an educated decision. So. Same thing with her. It was, I'm not saying that Beyond Meat is a bad stock. I'm not a stock analyst. I'm just telling you tried and true investment principles that have been working very well since the 1950s in terms of proper, portfolio construction. You may want to still get the same kind of impact socially, but also blend it with more prudent kind of investment theory that we've used for a long time. So, all right, we're at the hour. I know we started a little late. Let me see if there's one more question here. Any thoughts or questions out there, anybody? I say this is an open forum every time, and then I end up talking a lot. So thank Frank for being here. So I'm not the only one speaking. But Laird, you look serious. You look like you have something on your mind. No, you're good? Okay. One thing I wanted to just maybe reiterate, we've talked about, I think, several times, and I talk about it in almost every meeting that I have with clients that are at this stage. But I just want to clarify RMDs and QCDs. RMDs stand for Required Minimum Distribution. So we always joke, that's the IRS's nice way of saying it's time to spend your money. We want you to spend your money before you die so that we can essentially tax it and get our revenue, because those retirement accounts are not designed to be multi-generational. So the new law said 72, you have to start taking minimum distributions every year, right? If you inherit an IRA, you have to take it immediately, essentially. So that's what a required minimum distribution is. So Laird, I know you're taking some RMDs. What people get confused by, I think it sometimes, it touches into the tax stuff that we were discussing before, is that those RMDs are going to now be added income, right? So if you have portfolio income and you have pension income and you have Social Security income, now you have a required minimum distribution that's going to be added to all that income. So unfortunately, people start paying more and more tax and creep up in the tax brackets in retirement more so than they ever thought they would. So what Frank and I, when we're reviewing tax returns, we're trying to minimize that. And so looking at RMD strategies, can you do something different with that income is one particular area. So a QCD is what's called a qualified charitable distribution. And a qualified charitable distribution means instead of you receiving the required minimum distribution in your bank account, you're actually directing that to go directly to your charity of choice. And by doing so, because you never touch it, that money is never received and never taxed to you, okay? So that's a way of minimizing your overall tax liability and potentially how your Social Security is taxed. Because as you know, 85% of your Social Security could be taxed. So the more you can minimize your taxable income throughout the year, the less likely that's going to happen, and less likely you're going to go in a higher tax bracket. It turns into this vicious cycle for some people that are in retirement. Okay, I need 50 grand a year to live. It's being taxed. It's being taxed more and more. I got to take more out, which means more tax, so on and so forth. And it kind of spirals to a point where you end up spending your assets down a lot faster than you might think. And I think that's important to realize how those individual pieces fit together, especially if tax rates go up. We don't know if tax rates are going to go up, but if they do, that's going to be, our tax reviews and being cognizant of those different factors becomes more important. But back to the QCD, most people are giving something to charity every year, and it's usually out of pocket. So what we just say is, if you're already giving some to charity, or you intend to give some to charity, you're basically just turning off the charitable contribution from your bank account and turning it on from your IRA. So from a cash flow standpoint, the impact isn't really there if you're already giving to charity. It's just saving you on the tax side. So it's just a strategy that we employ. We look at employing every year. And it's acronyms. I think Frank and I are we both tend to do this. We talk about RMDs, QCDs, and things like that, but I just want to clarify what that is, because we have questions about it fairly frequently, and we'll be bringing it up again as a strategy to consider for people that do have RMDs. Frank, you look like you have something to say.
I was going to say, don't misconstrue what Todd said though about taking it, your RMD and turning it into a QCD. You can do a portion of your required minimum distribution as a qualified charitable deduction. Doesn't have to be the entire amount.
Right. That's a good clarification. Yeah. I guess I was just trying to simplify it. If you have $1,000 RMD and you're already giving $1,000 over here, you're just diverting it. But yeah, you're not. That's a good point. If your required minimum distribution is 25 grand a year, you certainly don't have to give that all to charity. You could do a portion of it. You can also do multiple charities too. So it could go to, West Side Cares. It could go to your church. It could go to 5 or 10. It gets a little bit cumbersome to do that, but that's possible. The other strategy that ties into this, and then I'll close for today, but you'll hear us talk about too, is bunching your deductions. So if you look at any of your tax returns, you're probably not getting the deductions you're used to. And that's because the standard deduction has been increased quite significantly. So sometimes it's important to look at, like, say you're charitably inclined or you have property taxes, bunching those so that you pay 3 years in 1 year, just hypothetically. So that puts you over the standard deduction so that you can now itemize. Most people don't itemize in retirement just because the standard deduction is so high. They don't really have mortgage insurance or mortgage interest, which tends to be a big one. Their kids are gone. So for them to itemize or do what used to be called the long form is harder and harder. So bunching strategy is something to consider as well. You can do that with charity. You could do that with property tax, a number of things. So I just wanted to throw that out there. All right, questions in closing. Anybody have anything to say or thoughts?
Can I throw one last thought in on the QCDs?
Sure.
There's kind of a planning opportunity that was created by the tax changes in 2017. They changed the RMD starting age to 72, but the QCD eligibility age is still 70 and 1/2. Right. So there's a 1.5 year period right now where even if you're not required to take required minimum distributions from your IRA, you can still make QCDs. It has the same effect. And what it does, in the long run, it lowers your IRA value, still gets the money to the charity in a tax efficient way, and could lower your RMDs down the road.
Right. Well, that's great. That's why I love you, Frank, the engineer. He always remembers the details that I maybe forget, being more of the big picture guy. So that's good. Okay, everybody. Well, I think that's it for today. Thanks for attending. We'll be here again Thursday at 4 o'clock Mountain Standard Time. We'll be sending out this recording. I think it'll be posted on our YouTube site for anybody that wants to watch it. And that's it. We will be in touch about our tax reviews coming up and any other webinars, so stay posted. Thank you, Laird. Good to see you. Good to see everybody. We'll talk to you soon.
Okay.
Bye-bye.